Good afternoon, ladies and gentlemen. I'm very happy to welcome you in my capacity as CEO of the Association of European Businesses to this event, which has been organized by the Finance Investment Committee. And certainly I'm very grateful to Stuart that he has taken this initiative to talk about the economic impact of the COVID crisis, a topic which certainly is of importance for all of us, for all of you. Given the current situation. Perhaps just some words about the Association of European Businesses. I think we have been reacting rather quickly with regards to informing our members and are reacting also quickly with regards to every new regulation that is coming out for the national level and also for Moscow, St. Petersburg, and some of the regions. I hope that you feel yourself well informed with regards to this. Second, the committees have been very active with regards to lobbying issues related to the current crisis. For example, some letters which have been sent on behalf of the automobile industry have been quoted prominently in the press in the past few days. This is certainly then, let's say, the public proof of what we are doing mostly behind the sceneries. I would also like to say that this is most probably the last event that I have the chance to talk to in my capacity as CEO of the association, because I'm going to leave at the end of next week, most probably. I would like to say that certainly it was a pleasure and an honor to work with the association and with all of you over more than 12 years. And I wish the organization and all of you all the best for the future. Given the circumstances, this might be important to wish such things. And I certainly would also like to say that I wish my successor success in his new capacity. And I would like, before then Stuart takes again over, leave the floor for some sentences of introduction to Tadzio Schilling.
Tadzio.
Stuart, Frank, thank you very much, and also for your kind words, Frank, and for your extremely valuable support. I mean, we've been working together directly after the election at the AGM, and so the transition is in full swing, and I can assure you that we have quickly set up our internal reaction force to how we cope with the COVID-19 situation, as well as how we can adjust our member services and our setup for the members to the fast changing environment. And as Frank said, I think the information, we try to keep it almost real time to provide it a guidance to the members, so that in this jungle of changing regulation, they can find their way through. We also obviously monitor the macroeconomic situation, and I mean, all of us follow the press and follow the news, and we see that this crisis, in the order of magnitude, both of the human impact, but also if we, as the virus is now increasingly also supplemented by considerations or by thinking about the economic crisis, obviously in the magnitude is tremendous. If we look at GDP loss, that could be unrivaled since the big rubles crisis in 1998. Then if we look also at the measures that are currently pulled together by the government, we also see that now the dimensions, they almost daily grow, and if you see the budget deficit that could come out of this, I think these are definitely questions that merit thorough analysis, and I'm very happy that this is an opportunity that we can provide this first-hand information from experts this afternoon. It will be my great pleasure to be at your service and to be close to the committees. And now I wish you a fruitful discussion with our experts and with Stuart, and a hand back. Many thanks.
Tadzio, thank you very much indeed. I just want to spend 1 minute saying a personal thanks to Frank. I've worked with him over the last couple of years, but I've known him for longer, and I think he's done an extraordinary job. He leaves the organization in a very strong position, I think it's a real tribute to his management that we can look forward to the next period concerned, but not at least concerned about our financial well-being and our ability to service our clients. So, Frank, both personally and organizationally, thank you very much indeed.
Thank you, Stuart. Thank you.
Okay, let's move to the topic of the day. This is a very complicated situation. Last year, I was asked to name 10 black swans at a conference. My simple answer was, well, that's simple. I can't, because they're unpredictable events. So don't ask somebody to predict the unpredictable. Having said that, this is, I would say, this would fit within the concept of a tame black swan, i.e. a black swan that we knew about, that we knew that there was such a thing, but we got used to the idea that it was manageable, and it's clearly way ahead of our expectations. It's been dramatic. It's taken us into unknown territory. I would say it's personal as well as global. Everybody is feeling this individually. And the idea that national borders can actually close across the world, well, I guess the last time that was happening, it was a world war. So our generation has not seen anything like this. Protectionism was already reappearing. It was appearing across the world. And in fact, we saw last night statements out of the White House underlining that, if we didn't already understand their position. Russia, better positioned than it was in the past. But as we all found out in 2008, the view that somehow we're cushioned from global events because of our position either in terms of the energy resources or in terms of financial resources, that can change quite quickly if this thing goes on long enough, and we don't know where it's going. So the question for today is, how well positioned are we? How vulnerable are we? So luckily we have with us three extraordinary experts to unravel this. It's always unfair to expect the experts to forecast something in a way that's 100% for sure. You can never do that. But we definitely have three people who are extremely well suited to address these issues. We have Annette Kyobe from the IMF. She runs the IMF office in Russia. And in addition, Vladimir Drebentsov is the chief economist at BP, Russia and CIS, to give us a view of where this fits in terms of the energy market. And as we all know, if you had a port available yesterday, you could have been paid $40 a barrel to look after somebody's oil for them, to take their oil. And finally, we have Chris Weafer, who I think most of you probably know, the CEO of Macro Advisory, certainly one of the best commentators on the Russian market. So the way we're going to work this, we're going to ask, please, that you stay muted as the audience. If you can feed in your questions, we will leave questions to the end, and I'll get them. I won't get them on my screen, otherwise I'll be doing this all the time. I'll get them on my phone, and then we'll get through them at the Q&A session after the presentations. So I think without more from me, can we turn, Annette, to you? I wondered if you could give us a view, kind of like macro view of what's going on and where Russia fits within that. Over to you, Annette.
Hi, everyone. Welcome. I hope that everybody's well. Thank you, Stuart and Frank, for convening us to share our thoughts on this slightly strange and definitely very difficult conjuncture. In my presentation, I'll give you a brief overview of how we at the International Monetary Fund view this economic conjuncture, specifically for Russia, but also for broader Europe. Let me get straight to the presentation. So the number of COVID cases has been growing quite rapidly. Russia seems to have been hit much less severely than most other European countries. According to official statistics, as of yesterday, there were 47,121 cases confirmed in Russia, with 405 deaths from the coronavirus. It's not yet clear why, but Russia has a very low COVID mortality rate. This is around 1% compared to an average of 6.9% in other countries. Perhaps this could be explained by the authorities' kind of quite aggressive and early containment response. They started preemptive containment quite early at the end of December with temperature checks at the Chinese border, even before news of the epidemic in Hubei was announced to the rest of China. This was around January 20th. The authorities proceeded to progressively close the border with China and some European countries. They mandated self-quarantine for people arriving from abroad, and also quite early on quarantined people at risk. So this is elderly and those that are immunocompromised. On March 30th, they announced an open-ended quarantine in Moscow, requiring non-essential businesses to close and people to remain indoors. The response has been probably less draconian at the regional level. The federal government has asked regional governments to implement containment policies commensurate with the extent of infection in their regions. So what do these containment policies mean for the economic outlook? We are in the truly exceptional situation of deliberately shutting down our economies, specifically those sectors considered non-essential. The way that non-essential sectors are being defined means that they account for about 1/3 of the average European economy. The Italians were the first to propose a definition of non-essential sectors. So this implies that a closure of non-essential sections for 1 month would lead to a drop in annual GDP by about 3%. We assume the closures will last for 2 months. Thus, the impact is expected to be at least 6% of GDP. However, it will likely be more, as the reopening will only be gradual. Turning to Russia, the country's been hit double hard in some sense. First, the COVID shock, and then the related collapse in oil prices. In common with other countries, we assume an initial containment period of around 8 weeks. We're about 3 weeks in. Followed by gradual reopening of non-essential sectors. This implies very significant temporary output losses in industries such as tourism, transportation, and education. For tourism, we assume 100% hit on the sector, as the tourism season is effectively from now until about September, October. With this, let me turn to the outlook. And it's not saying it lightly, but the outlook is grim. We assume in our baseline that the lockdown affects or begins to affect the economy at the end of the first quarter and most of the second quarter, leading to a calamitous drop in output in the first half of 2020. The outbreak is expected to be contained around mid-year, but perhaps in retrospect, this is a somewhat sanguine and optimistic assumption. It's yet to be seen. But in these set of projections, which we unveiled to the world a little over a week ago, we assumed that growth would rise gradually from about the third quarter, but activity would remain considerably below normal. As you can see from the right-hand set of numbers, in our forecast, Europe will experience a recession that is much worse than the global financial crisis of 2009. We project GDP to fall by some 6.5% or 6.6% of GDP in 2020, compared to a forecast of around 1.5% last autumn. We expect Russia to fare a little bit better, with GDP growth to fall to minus 5.5% in 2020, compared to a forecast of plus 2% last autumn. We're probably on the more pessimistic side of consensus forecasts, at least from the numbers that I've seen. The authorities are yet to present their view of the economic outlook. I think the first set of numbers will be presented by the central bank on April 24th. So I think everybody is watching those. Usually the Ministry of Economy goes first, but given the huge uncertainty around the numbers, they've decided to wait a week or two to get some high frequency numbers in for March and early April before assessing the state of the economy. But even this grim baseline forecast and outlook is subject to notable downside. You hear this a lot from the International Monetary Fund, but I think this is the first time we as an institution are publicly announcing adverse scenarios around our baseline. Usually we just present a baseline forecast and stick to it, but for this round of the World Economic Outlook, we're also presenting adverse scenarios around our baseline. So first, what I want to say is that the baseline does not assume that major disruptions could continue until a cure or a vaccine is available. Second, the baseline does not anticipate widespread balance sheet impairments with households, corporates, and governments going into debt distress. This is a big discussion in the markets, but we do not assume this in our baseline forecast. We don't see it yet, but it's something that, of course, we're following very closely. Should these risks materialize, many countries will face significant difficulties maintaining the strong policy response seen so far. In the interest of time, I won't get too much into the debt debate in the European Union. I think coming from the AEB, you're more than familiar with this, so we can leave it to a Q&A if needed. I wanted to highlight our adverse scenarios just to give you an idea of how bad we think things could get. To remind you, our baseline assumes 2 months of closures, a recovery in Q3 and limited balance sheet damage. But as you know, the concern is that social distancing measures may need to be maintained or reintroduced until vaccines are available. Experts say in 18 to 24 months, and this is if we are lucky. Our downside scenario is much less extreme than this. It assumes an additional month of closures, deeper balance sheet impairment, and a weaker recovery compared to the baseline. So here I show the level of GDP, and what's important to take away is that the level of GDP is not projected to reach the pre-coronavirus trend under any of our scenarios, not under the baseline and certainly not under the adverse scenario. In the baseline, we expect permanent output losses of some 5% by 2025. In the downside scenario, losses could be double this. Let me turn to my final slide, which is just going to illustrate the policies that governments have taken. I won't spend very long on the Russia policy response because I understand Chris will cover that in his presentation, but I will be happy to take questions at the end of all of our presentations. So far, what we've seen is that the unprecedented shock has really triggered an unprecedented policy response. As illustrated in this diagram, country authorities have deployed truly the whole policy arsenal in the fight against this epidemic pandemic. Again, being in the AEB, the Bank of England has resorted already to monetary financing of their deficits. Other central banks are massively purchasing assets that they wouldn't have thought of. So all of this to say, the amount of policy support provided by central banks and ministries of finances have truly been quite large. With the strong macroeconomic framework Russia has put in place over the last, I want to say 10 years, low public debts, ample international reserves, it's relatively well placed to respond to this crisis. So everybody talks about the National Wealth Fund, which is in the order of 9% of GDP. But let's not forget that the central bank is sitting on something like 570 billion in reserves. So compared to a lot of other emerging markets, Russia is very well positioned to weather this crisis. The authorities have announced significant measures to mitigate economic costs. And If it's needed, they probably will be ready to support the economy further in healthcare and, of course, affected individual firms and individuals. In terms of the specific action plan, the Ministry of Finance is to provide fiscal support in the amount of 2.8% of GDP. This was announced last week by the Minister of Finance. For households, this will likely come in the form of unemployment insurance, direct income support, sick leave, and tax deferrals. The firms, as in other European countries, will have loans guaranteed and also be granted wage subsidies. Meanwhile, the Bank of Russia has announced regulatory forbearance and lowered capital requirements by releasing countercyclical buffers. And I would like to note that the authorities have also indicated that they're ready to take further measures if and when needed. I just want to stress that we are fully supportive of strong policy responses across countries. Of course, it is very important that they be well targeted, temporary, and also importantly, avoid socializing pre-existing losses. But time really is of the essence in this particular crisis. And above all, the policy response, in our view, is about saving lives and minimizing social hardship. And we also believe that forceful measures very early on in the crisis are needed to support individual and firms' balance sheets to improve prospects for a stronger recovery. With this, I thank you for your attention. I really look forward to Vladimir's and Chris's presentation and, of course, to your questions. Thank you.
Annette, thank you very much indeed. It's sobering stuff. And I can think of a few questions I've got for you, and I'll keep my mouth shut. But certainly by the end of the next two sessions, there will be a number of significant questions. That was very clear. And, you know, we've all seen crises before if we've been in Russia. This one's a real Lulu. Okay, Vladimir, I wonder if you could, Annette said that there were, you know, that Russia was hit twice, once with the virus and once with the energy shock, the price. Here we go again. Of course, the recent past, the words have been, or the assurance has been that we're moving away from this direct dependence on energy, but it's obvious that this remains a major driver. So over to you.
Thank you, Stuart. You see my slides, right? Because I don't see them on my. Okay.
Yeah.
Challenges that the oil market currently faces are of multi-layer nature. We already heard about the first one. It's an economic crisis, and the main uncertainty is, of course, how the world will go out of this crisis. Everybody at the moment assumes a sort of V-shape recovery, but it's easy to imagine that it may be not just a much slower recovery, it might be a multi-V-shapes recoveries. Because if we see the second and the third wave of this pandemic, we might have not just to reintroduce self-isolation measures, we might go for another lockdowns. But what makes this crisis even more peculiar for the oil market is that it, of course, affects the transportation sector more than many others. As you may see on the screen, the number of flights in the world has just collapsed. And if we learn from the China's example, which you see on the right-hand side, after the lockdown is over, the number of flights recovers very slowly and actually to a much lower level than before the lockdown. And that's what Annette mentioned by the changes in the sort of people's behavior. And that's, again, that's the new reality which we will have to face. And even more importantly, we see the same impact on the road. On the screen, you see slides for a decline in driving across many developed and developing countries. And as you may see, the picture is pretty similar. basically it's halved. And of course, it has direct impact on consumption of gasoline and diesel. Well, actually, gasoline more than that. And actually, if we combine consumption of jet kerosene, jet fuel, and gasoline, only these two fuels account for about 40% of global oil consumption. So if we don't see recovery to the previous levels after the lockdown, it's pretty clear that oil demand will be hit a lot. And that's what you see on the current slide, which exactly shows that gasoline consumption in the US just halved year on year in the early April. Similarly to the economic recovery, people who try to look at what might happen to oil demand also assume a sort of V-shaped recovery. So the second quarter, the current quarter, will be the toughest one, but then we'll see less decline in global oil demand because countries will be coming out of the lockdown. But frankly speaking, I see a lot of a lot of skepticism and actually negative second thinking recently in this respect. On the right-hand side, you see forecast by the same consultancy, IHS Markit. On the left-hand side, that's their chart from March, and then on the right-hand side you see their recent slide, and actually you see that they now think that the trough in the second quarter will be 6 million barrels per day deeper than they assumed just weeks ago. And frankly speaking, I'm not accusing this agency because that's a general trend. On this slide, which the Russian Institute of Energy and Finance has compiled, you see a comparison of what people thought just in the beginning of March and what the same or other consultants think at the moment. So basically, in early March, people still thought that global oil consumption will not grow. To remind you, the sort of average oil demand growth is about 1 million barrels per day a year. In recent years, it was closer to 1.4 million barrels per day. So this year, people thought, okay, because of the pandemic, we won't see oil demand growth. But just month and a half later, people realized that no, it's not a problem of not having growth. It's a problem of having decline of above 20 million barrels per day. And that's exactly what you see on the slide closer to the right-hand side. Okay, of course, oil exporting countries realize this challenge. I am not going to speak much about what happened in Vienna in early March and what has changed since then, because it will take a lot of time and there is a lot of speculation around that. And frankly, I just don't think it matters. What matters is more comparing announced plans by the OPEC Plus alliance and what we will likely see in practice. So this table compiled by Fisheraki basically shows that although the headline number of a cut in OPEC Plus crude production is about 9.7 million barrels per day, an actual cut, which we'll see in the first half of this year, is about 7.5 million barrels per day, for a simple reason, because the base year, which was assumed for the cut, or actually the base month, is October 2018. But the oil market will have to balance now, not back in 2018. So what matters is the difference between what the world had in the first quarter of this year and what we will have this quarter. And to remind you, that's on this slide. So in the first quarter of this year, the decline was about in demand because of China primarily was around 5 million barrels per day. So if this quarter we are likely to see more than 20 million barrels per day decline in consumption, it is clear that the world has to deal with around 16 million barrels per day of redundant oil production. And of course, this slide shows why the situation happened. It's because, well, partially happened, because it's not was just a cut in demand in many countries, but also increase in production of some OPEC countries in the Gulf. So that's a aggravated situation. But anyway, so if the actual agreement will cut only 7 million barrels per day, and the world needs to cut 16 million barrels per day relative to the first quarter to balance, it is pretty clear that something has to happen with extra 8.5 million barrels per day. So what people are currently expecting is that, of course, we already see some decline in oil output around the globe. The place which is in everybody's focus is, of course, tight oil production in the US, and as you may see on the slide, we are likely to see some decline pretty soon, because it's sort of the sector which has the shortest reaction time to changes in prices. But still, at the moment, people think that yes, of course, the tight oil production in the US might decline by 2-3 million barrels per day, but most of the decline will actually happen closer to the end of this year and in the next year. So basically, it's not likely to help the world to balance in the current quarter. So that's the main issue. So at the moment, we see around 400, 600 KBD decline in tight oil production in the US. So just not enough. And that's the slide which actually shows what and why is happening in the US tight oil production. Basically, the short reaction time relative to conventional oil fields is explained quite simply. In the tight oil business, unless one drills a lot, natural decline in existing wells will drive production numbers lower pretty fast. But because of hedging and other issues, as I said, people still think that we are likely to see a decline in the US tight oil production closer to the end of this year. And that's what we see on this slide. Again, that basically nobody expects a decline in US tight oil production of more than, say, at best 1 million barrels per day this quarter. There is decline in the Canadian heavy oil production, actually the part of it which is exported to the US by rail, and there are other cuts around the globe already happening. But on my count, I think that we are not likely to see more than 2 million barrels per day of decline in oil production with the current prices. So, which of course brings us to the issue of where this redundant oil will go, and of course the only way to dispose of it is to put it in storage. As Stuart has mentioned, yesterday was a lucky day for somebody who were able to buy a May contract for WTI, but actually, frankly speaking, it was a very peculiar and limited situation. Again, if there are questions, I may explain in detail. But even yesterday, it was more important to look at, say, IC Brent contract, which is a June contract and which traded at $26 per barrel on the same day as WTI became negative. But anyway, so the problem is that the world is going to have around 10 million barrels per day of oil to do something with. And that's actually when economics of storage and transportation becomes even more important than the usual sort of economics of producing oil, which which most of the people still have on mind. This slide shows that basically there will be not enough onshore storage capacity to absorb the glut, this redundant oil that we will see this year. In a simple example, it shows that in the US, oil storage is likely to reach 88% of the available capacity. And to remind you, the US has the largest oil and product storage in the world. And why it's 88, not 100, is very simple to explain. Because unlike in Russia, where various types of oil are blended into euros, usually people don't do that. So because of technical limitations, it's just not possible that utilization of storage goes above 90%. Okay, so onshore storage will not be enough to absorb this oil. And of course, what people usually do in such situations, and we did see that during the previous financial crisis of 2009, is that people put oil in floating storage, in tankers. The problem this time around is twofold. To start with, there is just too much oil, which will be redundant this quarter. The second issue is that because of the situation in March, when the Saudi Arabia hired extra 21 super tankers, because there are plans to increase deliveries to Europe and other regions of the world, freight rates have skyrocketed. So at the moment, the daily rate is around, for a super tanker, is around $300,000. So to give you a simple example, for instance, if we see a difference between today's price and 1 month's futures of $4, it's not enough to incentivize putting oil into the oil storage. Because a person who would buy oil for a super tanker, which with a capacity of 2 million barrels per day, will make $8 million on keeping this oil for 1 month. But this person will have to pay $9 million for renting this tanker. So again, as I said, economics doesn't work. And then it's very simple, and that's in every textbook, but it's also in real life. What needs to happen is that the world needs contango in prices. So basically, this contango, the difference between futures prices and today's physical price, should be enough to incentivize people to put oil into floating storage, which, as you may realize, and as I've mentioned, is much more expensive than onshore storage. So the problem with this at the moment, although we do have a super contango, so the difference in futures prices and today's prices of more than 10%, it's still not enough for people to hire super tankers. And given that we don't expect the freight rates to decline much, it basically means that to see oil absorbed by this floating storage, we need to see either the far end of the futures curve to go up, or, unfortunately, the front end to go down. And that's why, although, as I said, what happened yesterday was sort of an anecdote, we are likely to see prices in the current quarter, I mean, for physical deliveries to go down, because otherwise the floating storage will not enough. And actually it might be just physically that floating storage will be not enough to absorb all redundant oil, because basically the world has 800 super tankers, VLCC, with a capacity, as I mentioned, of 2 million barrels per day. And we also have 600 Suez Max tankers of 1 million barrels capacity. So we still need these tankers to trade oil. So around 1 billion barrels capacity of the tanker fleet is utilized for trade. Okay, with cuts, we will need less tankers for trading oil, but still, basically we might not see enough tanker capacity to absorb all the oil, which means that somebody will have to go for more economic cuts. And that's what will happen, not because investment plans change, as you may see on the slide. Basically, most of oil companies have already slashed their investment plans. But for many conventional fields, it will have impact only, say, 3, 4, 5 years from now, because that's basically the investment lag, the difference between taking FID and bringing oil to the market. The only type of oil which has faster reaction time, as I mentioned, is US tight oil. So, as I said, this quarter will likely be very tough on the oil market. And what happens in the third quarter and later in the year basically will depend on the economic recovery and on how and whether people resume their previous habits in driving and flying. And that's a big uncertainty. So I would say that what we see in the current forecast is the sort of best case option. And let me end with just a couple of slides which shows why the OPEC Plus agreement still matters. It matters because it doesn't solve the problem of the current and next quarter, but it does help the global oil market to balance in future. And that's exactly why, if you recall, the current cut not just tackles 2020, it actually goes all the way down to 2022. So it sends a signal that the alliance is prepared to manage prices on the market for this period. But still, I think that the message is that they will try to keep these prices at a sort of medium level, not higher than $50. Why? For a simple reason, because the oil price was above $50 in recent years. We've seen FIDs for more than 2 million barrels per day taken in each year since 2017. And actually 2020 was supposed to be the fourth year with FIDs exceeding 2 million barrels per day, which means that basically a lot of this oil, as you may see in this North Sea example, comes for high-cost producers. And that's what the current situation will help the oil market to solve. So it's not basically the US tight oil, which will come back as soon as prices go above, say, $40 per barrel, but these more expensive projects will likely stay on the shelf, and that's why the current agreement is not useless. Okay, let me stop here.
Wow, thank you very much, Vladimir. That was a real deep dive and very informative. You know, if I'm so far, so we're looking to Chris to cheer us up, but so far, you know, we haven't really priced in the downside of the balance sheet impact, and we've assumed that we're all going to get back in planes and cars and do exactly what we did before, and that's how the bounce is going to happen. We'll get to this in Q&A a little later on, but Chris, now we get your view of all of this and its impact on Russia, and built into that, I guess, you know, whether or not the Russian authorities are doing enough that they've announced, and if they've got the firepower to deal with this. So over to you.
Okay, thank you, Stuart, and good afternoon, everybody. Yeah, obviously, it is easy, I suppose, to depress ourselves looking at different scenarios and looking at the news and how bad everything is getting, and how difficult this is to see how it ends. And unfortunately, I'm not going to give you any good news to change that. I certainly would describe myself more as a pragmatist rather than either as an optimist or as a pessimist. And This is, for a lot of people, Stuart and others included, I guess this is our fourth crisis, 98, 99, 08, 09, and 14, 15. So we're looking at, at the parameters for this crisis, the differences, where things are better, where things are worse. So at Macro Advisory, what we do is we create scenarios, lots of scenarios, because it is, to be perfectly honest and to be very clear, I guess, with everybody, it is far too early to be, to be able to kind of create a kind of sensible scenario. There are far too many variables and far too many things are going to change and will evolve both globally and in Russia. And we've already heard from Vladimir on the oil price uncertainty. So a huge amount of uncertainties. And as these kind of uncertainties start to clarify and as we get some trends, then clearly that will impact our scenarios, and we will be on a regular basis, I would imagine every month, if not every 2 months, we'll be updating the scenarios based on what's happening. So let me start the presentation, and this is usually where it all goes wrong, because me and technical buttons don't usually go that well together. So I'm going to try and get the screen up. I have a few slides to share, and I think, yeah, hopefully that one works. So it's kind of start off with a little bit of good news, and we can dwell on this for a second, because this is the last good news chart you're going to see for quite some time. This is the leading economic...
Could you make it full screen, please?
Full screen, yes, sorry, full screen. Is that slideshow? Is that full screen? Okay, hopefully.
There you go.
Great, thanks. Okay, so anyway, yeah, it's good to put it full screen, because this is the latest leading economic indicator for GDP. It is the February number, and as I say, it's the last piece of good news we'll have for a while. It shows that pre-crisis, if you like, the economy was on track for what we were hoping for, which is around 2% or a little bit better, 2% growth this year, and that was on the back of a very strong start with retail sales, which were very strong in both January and February. We saw real wage growth, again, with government efforts to put more money into people's pockets, as Putin talked about in the Federal Assembly address, and also, greater effort to push spending national projects and to get more budget spending out faster compared to what happened last year. So we did have this kind of good start and kind of optimistic start. And of course, that didn't last very long, and there's always a but. And of course, as Annette has already talked about, the issues that we're all very familiar with. We're all on lockdown, industries are on vacation, the oil taxes are going down, the government is now much more focused on spending money to support people and key parts of the economy, and the confidence indicators, even if the IHS market services indicator for end March already showed kind of what's coming, and it was a big collapse from I think about 55, which 50, as you know, is break even. Above 50 shows economic expansion, or at least companies planning for economic expansion. Below 50 shows that they are more negative, and it fell from about 56 to 37, I think, if I'm quite correct in those numbers. So it was already coming down. And of course, we already know anecdotally from talking to people in their ministries and checking what's happening, etc., is that a large part of the national projects are almost in suspension at this stage while the government figures out what should be its priorities. So it's all changed very, very quickly, as we know. It is, though, kind of flicking back the kind of slightly more optimistic side. And it is fair to say, again, fourth crisis in since we've been here, Russia is in the best position than it has been in previous crises. It's in a relatively good position compared to previous crises. It's also in a relatively good position compared to most other countries. It's certainly in a relatively better position than Saudi Arabia, despite what they say, and many other kind of big oil producers. And a lot of it is because Russia has been forced to deal with external pressures since the start of sanctions in 2014. I would say it's a fairly safe thing to say that had we not had the sanctions of 2014, then the country would be much less better prepared today. I mean, in terms of financial resources and the impact of oil. But you can see that financial reserves have gone up. That's over $100 billion over the last year. In the central bank, the National Welfare Fund at the beginning of March was 160. Of course, some of that now been spent on the Sberbank issue, etc. But nevertheless, it's reasonably liquid. The debt burden is very low, so it's not an issue. Russia doesn't have to kind of worry about restructuring debt to any great extent, doesn't have a big element of debt servicing or need to scratch its head where it's going to find all this money, as is typically the case in European countries and other developed economies right now. So it is in good position. And what it means is, therefore, in practical terms, the government does not have to panic. And maybe they're being, all governments are being criticized for what they're doing in dealing with COVID-19, with few exceptions. And it's, you know, damned if you do, damned if you don't. So it's really only history will say who's done it right. But Russia, at least this time around, doesn't have to kind of put in place knee-jerk reactions as we saw in different crises. It can afford to take a bit more time about considering its policy response, its budget response. It has enough kind of liquid cash to divert into the support mechanisms that we've now seen. Certainly they could be better, and hopefully they will be better or more extensive as we go forward. But it doesn't have to panic as it previously did. As I say, much less vulnerable to oil price. And of course, this is the budget rule or the fiscal rule, which, as we know, has now determined that the average oil price in the budget should be 42, rising maybe to 44 euros. And as we know, last year, the budget would have balanced, I think, somewhere around $50, give or take, with the combination of weak ruble and the changes to the budget, and compare that to $115 in 2013, or Saudi Arabia needing $85. So Russia, you know, that is a positive factor that we certainly can put into a category and say it's one of the differences, at least when we look at how Russia is positioned this year. Now, certainly not one of those people who will say that sanctions have been good for Russia, simply pointing out that Russia has been forced into dealing with sanctions, and some of those actions have actually been positive or left the country in a better position today. I mean, clearly we're all aware of what the negatives with regard to sanctions are and the difficulty of attracting investing. But in terms of adjusting the balance sheet and the budget and creating these reserves, that's at least been one positive that we have. In terms of the ruble, I think last I checked, the ruble was back up at around 77.5 with the oil price collapse. There is no evidence that the central bank is spending any significant amount of money whatsoever in support of the ruble. This is what they have told us consistently. They learned that lesson in early 2015 when there were predictions that Russia burning down its reserves would have bankrupted the country, etc. They learned that lesson, and they're not going to do that again. So the sense we get from talking central bank is that, yeah, the ruble is being driven by factors outside of Russia's control, i.e. the oil price. And they're not going to, try to intervene until there is some settlement in oil. And of course, when you can see the graph coming down towards 72.5 in the last week or so, I guess the hope was we were heading that direction, but that's now, of course, off the table again until we get some settlement on the oil price, wherever it'll be. It is clear the government would certainly prefer to see a 65 ruble versus the dollar rate, and for it to be stable around that level. And that's kind of where we were at the start of this year. That's their preference, but will not spend any significant amount of resources. I mean, a couple of $100 million a week, really, but nothing in terms of billions or billions. Waiting to see where oil settles and then seeing where the ruble is. And of course, do bear in mind, it's not all negative with regard to the ruble. First of all, we're not going to have the same inflationary impact of this ruble weakness as we saw previously. Again, I referred to early 2015 when inflation spiked up to 17%. That's not going to happen this year, so see confidently. And one big difference is because the basket is quite different. Russia now imports a lot less in terms of food and other items that are in the basket. Import substitution, the kind of growth of domestic manufacturing in areas like food and services, have changed that. So yes, there will be inflationary pressure, but nothing like what we had before. Secondly, weak ruble, of course, we know has been one of the main factors in boosting exports in areas such as agriculture, food, and some other areas that we're beginning to see kind of grow. And then Russia's starting to attract investment as a kind of location to manufacture goods for export to other markets. So it's not all bad news with regard to the ruble, but clearly it's a huge negative when it comes to trying to attract investment. And there are some, you know, inflationary pressures. I put this graph up here in reserves just to remind you again, and it did mention this, the central bank has been minding its money, 563. If we were to put the Saudi number beside that, you could see the Saudi number coming rattling down. I remember in 2015 that the headlines generally were that Saudi had so much more money than Russia, could survive any crisis, Russia would go broke. And it really has now flipped. Saudi's reserves are now below 500 million and heading down, whereas Russia's reserves are 563. Maybe approximately stable. So again, it just reinforces that message. There is money to deal with this problem. That's not something that Russia had before. It was always scrambling to find resources, to figure out what to do. This time round, at least it's in a better financial position. So we're not going to have a financial crisis. We clearly have a growth crisis, but we're not going to have a financial crisis, at least unless things deteriorate rapidly. And I mentioned on inflation the key rate, the central bank policy meeting is coming up on Friday. Here, as Annette mentioned, we should get maybe some clarity on how the central banks see the trend over the last several weeks. It's certainly not going to be any good news out of that meeting. With regard to what they do with the rate, well, we heard from the Governor Annette that she was a couple of weeks ago hoping to be able to cut the rate to help the economy. I think that's now off the table completely. We see where the ruble is going, you know, the back of weakening oil. So I would say, well, what I'm hoping is they'll just keep the rate unchanged rather than raise it. But I think the chances of a rate cut, because of what we now see in the financial markets, I think will certainly be delayed for a better day. But at least on the inflation side, we can see this is a much different picture than we've had. In terms of where inflation goes, well, of course, I remind you that the central bank, in any case, we're looking for inflation to rise later this year. So they have an end year target of 4%. That's now going to be higher, but not materially higher. You know, it will be going up, but we're not looking at double-digit inflation this year. There's no reason for that. In terms of what's next, and I'm conscious of time, so I'll plow through this. In terms of what we expect from the government, and I'm looking at this in different phases. In most government response, phase one, we're now currently in. It's dealing with the emergency, dealing with the situation, putting money in place to help people survive through it, to try and keep as many businesses as possible with the lights flickering so they have a chance of recovering. That's where we're now in, and it's still ongoing, and clearly we can see every other day new measures to dealing with this. Phase two, I would expect, I think late May or in June, and that would be, in my opinion, would be the first interim budget adjustment. Again, reflecting the changes. We hear that the finance ministry are looking at different scenarios, using perhaps oil price assumption down to $20. Or, you know, other different scenarios and what it might mean. So first changes in terms of spending and budget changes, and perhaps some indication of where government policies are changing, particularly with regard to national project spending, etc. We should get that late in early June. And what I hear is quite likely there may be a government meeting in those dates that were set aside for SPIEF. So first week of June is when and there'll be a couple of months of economic trend for the government to use then as well. You know, in the summer, again, assuming that, you know, that the situation with the virus is calm or, you know, doesn't fall off a cliff, then we can maybe a kind of a calmer assessment of what the impact is on Russia, what it'll mean, and what therefore government should be looking at. And that then leading to, in the early autumn, perhaps September, a more comprehensive review or adjustments to the budget. So I think phase two is where we get a first round adjustment based on the current reality, and phase four in the autumn where we get a more extensive review of the budget and then more extensive kind of description of priority changes and how Russia sees the impact of the virus and the low oil price and what it's going to do about it. So, you know, there will be both opportunities, of course, for companies and as well as as well as challenges. And the critical factors, just to remind you, I'll go through them: COVID, global oil price, change the budget. Confidence, of course, will be a big factor. As we'll see, we'll be watching those indicators quite closely as to what people and companies do. And of course, investment in national projects. The one thing that I should say, though, is that, which is very encouraging, and we have regular discussions, informal discussions with different people in government at different ministries. And the one message that is coming across consistently across all of them is that the government is thinking more about what they can do afterwards to improve the investment climate. What can they do to bring investment in? There is no sense of, you know, we've got to pull the barriers down or isolation. The narrative across the board, at least as far as I can hear, is much more of what can we do later to open up, to accelerate investment, to bring more investment in. To just show you two of our scenarios, and as I think it was John Maynard Keynes said, when the facts change, I change my opinion. What do you do, sir? So I think we kind of obviously in this environment, we're bearing that in mind. These are provisional. This is our base case. This is probably around consensus right now. GDP decline this year, rising next year. That, of course, is based on a relatively short-lived kind of oil crisis and some opening up of global economies and Russian economy, you know, before the summer. So again, a modest deficit, sorry, the surplus, a deficit this year of 2%, average oil of 36, which assumes that it rises later in the second half of the year. The more pessimistic case, which is the one I think closer to what the IMF are talking about, you know, obviously you can certainly see, based on kind of a longer lockdown, a slower recovery, both globally and in Russia, and of course, a much lower oil price average for the whole year. In other words, $20 probably now, but certainly over the near term, rising there more slowly in the second half, but $28 giving us a year-end $80 ruble dollar rate, and then of course retail sales, etc., all impacting that, and the contraction lasting at least until the middle of next year. So yeah, I mean, we have a worst case scenario which is even worse. We have optimistic scenarios which there really isn't any point in putting up. So I just put the oil price there as say 36, rising up. This is base case, but I'm not going to dwell on that because Vladimir has covered all of that. So let me just, this is the last slide. Just to remind ourselves, the economy clearly will take a very big hit this quarter, you know, minus 15% GDP, minus 20 in April, all possible, minus 5 to 10% GDP in Q2 contraction. Yeah, absolutely would not be a surprise whatsoever. That's what we're looking at. Obviously, what happens in the second half, it goes without saying, depends on what happens with COVID and oil. But it is certainly, at least one of the positives, is that this time round, one of the key differences is that the relatively better, you know, fiscal position, budget position, balance sheet position that Russia is in, and it was not the case in the previous crisis. It had to panic before. It is not panicking this time around, at least not yet anyway. I should point out major, some problems, obviously, in SME sector. It's kind of a good news, bad news. The SME sector clearly is taking a battering. So if you're in retail, leisure, services, small manufacturing, there's no doubt about it. This sector is going to take a very long time to recover, and quite a number of, you know, bars, restaurants, shops that we're used to will simply not reopen after this crisis. I think that those are simple facts. But the good news with it, being perverse, but being put an economic hat on it, this is, as we know, too small a section of the economy. This is a problem for long-term growth, and clearly something that structurally Russia needs to address and has been talking about for a long time. But it basically means that even though this sector will get absolutely battered, the headline numbers still should recover based on the fact that the big industries and big state companies, of course, are in a better position. Also, the question mark over the banks, and again, this is very much to do with the recovery trend. Banks are having to write off debts, they're having to furlough interest, they're having to give out interest-free loans. It's going to destroy the profitability in the banking sector. It's going to severely damage, if not destroy, their ability to lend more money unless they get injections from the state. So that's a huge question mark over recovery. What state the banks will be in, what would they be able to do? And we can certainly talk about that. And the last two things, national projects, priorities will change. I think if you look at the list of national projects, areas, such as education, culture, perhaps training, these programs are going to get delayed. They're not current priorities. I would expect some readjustment in the order of priorities, greater focus clearly on healthcare, but on digitalization, perhaps in some infrastructure projects. But I would imagine that we will see a changing of emphasis on national projects. And then finally, localization, just in terms of doing business in Russia, as I mentioned, that one of the optimistic, or what I am hearing on the optimistic side is the government thinking more about, how can it move quicker to improve the business climate, to attract more investment, to make Russia a better place. But localization certainly will be part of that. And we're already aware of it, I've been dealing with this for the last couple of years, but much, much greater emphasis. And I think that hopefully the carrot will certainly be a little bit bigger to start with, but I think the stick will be a lot bigger as well. So a lot more pressure to get on with localization across more areas. I think that's one of the areas that we're likely to see. So Stuart, let me finish with that and then pass back to you, and obviously we can deal with then any questions when you're ready. And let me see if I can get this off the screen.
Is that some senior official calling you, Chris? Somebody else?
Yeah, I do apologize. Let me go quickly and tell them I don't need any PPI.
It's somebody from the finance ministry. Well, thanks, Chris. I've been around 25 years here, and certainly, and I have to say, Finance and Investment Committee was where we were doing a lot of the sanctions briefings, and towards the end of the sanctions briefing, the only way that we could entertain any kind of lightness was to talk about Brexit. Well, I guess we've got something else to worry us, although Brexit still remains the thing we can talk about as if it can get done easily. That can still be a bit of a lightness in this environment. All of this is pretty heavy. And one of the fundamental things for me is this concept that it's a V, not a U or an L, that there is built into a lot of assumptions that somehow this arrives, we deal with it, and it goes away. And I think that's optimistic, and that all of our presenters, one way or another, have talked about that. And I just on Chris, another great presentation. I mean, one of my observations is we had seen that national projects hadn't been rolled out nearly as efficiently or quickly as we'd hoped. We then saw the change in the government. We were then looking at this year as a year where we were going to get that final traction. And now, unfortunately, everything gets put back another period of time. And now everybody can blame the virus for not having achieved their original targets. And that comment that you made about the SME, yes, on a realistic basis, it's a small percentage of the population of the workforce, but of course it does represent the counterweight to the growing percentage of state involvement in the economy, and for that reason alone was very important. So that is going to be something we have to live with, I guess. I guess just before leaving you, Chris, isn't there something here that says actually a lot of the business models are changing, a lot of the supply chain is changing. Doesn't a lot of the way we do business, as in right now on Zoom, this presumably creates potential new businesses, potential niches, and that in the same way that we saw the negativity of the sanctions, that created this opportunity for new approaches. Do you think that's true in this environment too?
Yeah, I think that absolutely goes without saying. Russia was one of those economies anyway that was embracing kind of the new way of doing commerce, particularly on the retail side. We look at the growth in Yandex and all its various businesses, from e-commerce to taxis and food deliveries, etc. It's one of the fastest growth rates in the world in those segments in Russia. And we know a lot of it is to do with the fact that there isn't the kind of the competing infrastructure of you know, high streets or the way people have got used to working or living in more developed economies. So, but we have seen this in Russia over the last 20 years, that when something new comes along, a better way of doing it is embraced much quicker in Russia. And I would absolutely see, you know, acceleration in areas like logistics, in, you know, financial payment systems, all sorts of online type of services, whether it's leisure or services or goods. Yeah, I definitely see those accelerating and continuing to accelerate as they have been. But I also think that, again, we've got to wait to see what happens in terms of, you know, follow through. But at least, you know, talking to senior government officials, they are kind of have almost been told to have a look at what they can do in their area to attract more foreign company investment, you know, to establishing kind of whether it's manufacturing or service base, not just for the domestic market, but for export as well. So yeah, it's you don't want to be overly simplistic, and you certainly don't want to be overly optimistic, but, you know, crises do create opportunities. And I think, yeah, let me say it. I think in relation to Russia, because Russia has been dealing with this kind of semi-crisis backdrop, I would say almost for 10 years. I mean, really, we hadn't quite got clear of 2008-9 when we went into 14-15. You know, there is this kind of sense of crises have to be used to push something, to make some changes, and hopefully something more positive. So anyway, look, bottom line is, without waffling on, which I apologize, I realize I am, I do actually see that companies that, you know, this in Russia is not a country that you really should be looking at, you know, let's shrink and survive. It's really a case that for our clients, we talk to them and say, you should be engaging with your contacts in government or regional level or wherever, and seeing where the opportunities are, be part of the process of creating those opportunities, because they are willing to talk about it and they want to do it. And that's a big difference. And hopefully it will stay like that and won't change. But in that sense, while the numbers look bad and you cannot be optimistic about the numbers, I'm at least more optimistic about the attitude.
Good, thank you. Annette, are you still around? I can't see. Are you there? Because I have a question for you.
Hey, Stuart. I'm here if it's a good question.
Oh, I see. Okay. Well, let's see. There have been some discussions about coordination in the European Union, and one of the questions that we've received is there a plan to, do you think, or are you aware of any sort of plan to coordinate between the European countries as they try and open up, as they go through this process of trying to re-engage after the lockdowns? Because each of the countries have gone through a different time period, and as they come back together, obviously one of the questions that everybody gets to raise is, how do you actually have any sort of transport links between the different countries if they're at different stages within this process? But do you think there'll be coordination? And I guess it's bigger than just the European Union. Is there going to be coordination on a global level, do you think?
Yeah, I'm going to have to give you a waffle answer to that question, because I don't cover the European Union in great detail. But I think they will definitely have to be coordination. I think first off, because a lot of the union members were annoyed with one another when countries unilaterally closed borders and closed labor markets to one another. So this was a big fault in the early response to COVID. So I think they would have learned from that, and there will be coordination in terms of how they open up. There's also going to be, I think, a transition matrix put in place for countries to open up, and several conditions are going to have to be met. I think the first condition is that transmission rates are going to have to go down to some commonly agreed level. The second one is that enough patients will need to be discharged from hospitals that, should there be a second wave of COVID, the health systems can reabsorb that. And third, there needs to be sufficient testing in place to kind of test the population much more than we've all been doing. So I think absent those three conditions, I can't imagine lockdown being generalized or systematically removed?
Yeah, well, that leaves a very big question mark, doesn't it? Because those things aren't in place, and I think one of the questions then becomes realistically how much disruption is this going to go? And you touched on it in your presentation that the amount of that both in terms of this time around, but also potentially in the future, could in fact be quite significantly worse.
No, I think we're in it for the long haul. I mean, there was one question about, whether or not in our assumptions we take into account what happens to global supply chains, for instance. And our baseline assumptions assume that they're left untouched. But I think, if anything, this crisis has shown that although global supply chains have been very efficient, they're also very, the opposite of resilient, in the sense that it's just in time inventory management. They're going to have to move to much more expensive modes of functioning. So perhaps diversifying suppliers, perhaps localizing some supply. So even if lockdown measures are removed and we do get back to some semblance of normal, it will be unlikely to look anything like the world looked pre-COVID.
Yeah, and the whole concept of the globalization, I mean, whether that globalization is in terms of supply chain or whether it's in terms of the free access, free travel access, obviously also is under question. And then that gets back to Vladimir's point, which is we've had this very significant decrease in both the flights and in terms of cars. There's a lot of hope, which is that we just bounce back from that. But obviously, you can't just bounce back from that if there are overriding sovereign restraints, which are driven by health concerns. So it's going to be difficult. Chris, I've had a number of questions on whether or not what's been rolled out so far in terms of support measures by the government here looks as though it's going to be sufficient to deal with the issues, or whether or not you think there's more, and how that gets financed.
It's not sufficient. I think that's fairly clear. The government is kind of still appears to be assessing the situation on a rolling basis and is discovering every time they do it that they need to kind of bolster the supports. So there clearly isn't enough money being allocated. There certainly isn't been enough money, anything like enough money being allocated to the small business, SME sector, and even, to that sector in general. So I would certainly expect to see more money being allocated. Where is it coming from? Well, of course, do bear in mind that the central bank either has recently or is about to transfer perhaps a one-off dividend of about $15 billion to the finance ministry. This is the, if you recall, the transaction where the central bank sold its equity in Sparebank to the National Welfare Fund for, I think, approximately $20 billion. I need to double check the numbers, but around that level. It's keeping, about 30 billion. I think it's keeping about 8 or 9 billion to cover the bailout costs of banks like with Cretia and the other banks that it's had to fund. And the calculation is that it should be in a position to transfer about 16 or 17 billion to the finance ministry. That's not in the current budget. Now, I know that's pocket A to pocket B, but it's a neat way of getting money out of the National Welfare Fund into the budget without having to go through the whole process of changing the rules or getting parliamentary approval. So that's 15, 16 billion there. And the whole purpose of National Welfare Fund, of course, is it's there to cover budget deficits. It's kind of replaced the old reserve fund. So the government can draw further directly from that. So for now, it's not an issue of where the money is coming from, even though the budget is running a deficit clearly every month because tax receipts are down across the board, not just on the oil and gas side, but of course across the board everywhere else. But there has been kind of a reduction in spending on some planned spending, national projects in particular. So again, we're only guessing at what the impact on the budget is at this point. We will find out perhaps in the next, maybe in May, late May, what has been the impact of the budget so far. But the quick answer is there isn't any issue with regard to accessing available resources. It is there. Either that 15, 16 billion one-off, or they can tap directly. Clearly, this will become a bigger problem in the second half, depending on where oil is, depending on what's happening in the economy. And then we might see, and that's one thing I should point out in terms of risks. I think that there is I would say a high likelihood of further tax changes to generate more money. Now, we've already had a first sample of this several weeks ago when President Putin announced a tax on high levels of deposits and also on cross-border transfers, dividend payments, etc. That is the first step. Now, I do not expect any changes in corporation tax, that 20% level. I don't think, because that would go against trying to incentivize investment. I do not expect the flat rate of 13% for low-income earners to change, but I certainly would expect to see higher rates of taxes coming into higher income earners. I think those kind of days of everybody benefiting from 13% tax are over, or will be over. This is definitely coming. I don't expect VAT to change, but I would think that extractive industries. Remember, Mr. Belousov, the first Deputy Prime Minister, when he, in his previous job as economic advisor in the presidential administration, he was the one who leaked that document suggesting that extractive industries, metals and mining sector in particular, were not paying enough tax, and now he's in a position to do something about it. So I do think there will, as we get into the second half and the government is able to better assess perhaps, or a better idea what the income tax situation and the hydrocarbon tax situation is balanced against what its spending plans are, we will definitely, I would say, in the autumn start hearing about proposals on tax changes, if not actually get them. So extractive industries is a target, high income earners are a target, and perhaps other areas of taking more money from those who can afford it, real estate or whatever, I'm not sure. But yeah, I think that that's definitely coming.
Thanks, Chris. Annette, here's actually one from me. The stock markets are meant to reflect, the current view of the future of a bunch of very smart people. But if you look at the rebound in the stock market that you've seen over the last short period, you've seen that it's clawed back much of the losses. If you listen to this call and absorb the information from each of the people that have been speaking, why would that lead the market, do you think, to rebound at the rate that it has, based on what seems to me like significant downside? Any thoughts?
I think the market is reacting to the extent of support given to the economy by the Fed. I think this is just the simple answer to that question. I mean, it's nothing more than that. I think perhaps also at the beginning there was an overshooting in terms of how bad markets thought this was going to be. But now with the additional liquidity support, I think they're of the view that perhaps this is not a V-shaped recovery, but refinancing deficits directly, completely bypassing markets. And I mean, it hasn't resulted in spikes to gilt yields or anything like that. So I think, if the shock continues, they could just continue pumping liquidity. I think the question is, at what point does this become a debt sustainability issue? And this will be the much more difficult discussion that we'll be having.
Okay. All right. Well, listen, we're running out of time. Technology has defeated me at some point, so I've gone dark. People should not read anything into that. It's something I did myself. And technology has won. I think we've had a very good session from all our speakers. I am afraid that I take away from this that the risk to the downside is quite significant. I think on a personal basis, it's about getting through the day by day. It's not about hoping that it'll all be over by a certain date, because I think we don't control that. And I think it's dangerous to set artificial horizons. I think all of us need to focus, first of all, on the health and safety of our families and our colleagues. I think there's plenty of things that we can do, and in terms of defining how we react to the environment, and we should get on and do that. I'd like to thank all our participants, and in fact we had a record 128, I think, which is fantastic. I've never seen 128 people at the AEB meetings, so except for the once-a-year ones. So that's super, and I'd like to thank Vladimir, Annette, and Chris for their presentations. We would plan to give a similar sort of update at some point in the future. I think it doesn't make sense to do this too regularly, but certainly after a month or two, we would come back to you and give you a view of what the horizon looks like at that point. So with that, I'd like to thank everybody, and we'll call an end to the meeting. Thank you all very much indeed.
Thank you, Stuart.
Thank you. Bye-bye.
Bye-bye.